Good afternoon and welcome to our end of quarter one 2026. This, I suppose it feels like we're already starting the year off with an absolute bang. Joining me, of course, I am Joel Kieran. We've got Will Cant and Ben Wise over in Sydney and Amber Dawson in Perth. So I suppose, yeah, it's a bit of a market, a bit of free for all at the moment. Earlier this year, we were focusing on sort of AI, easing inflation, and prospects of lower interest rates. And I suppose, wow, how things have changed. It seems like we're waking up most mornings now and having a look at the news and saying, oh, right, what's happened overnight? This has largely been driven by escalations into the US-Iran conflict, surge in oil prices, petrol prices seem to be flying over the news constantly. Obviously, as a result of this, equity markets have become a lot more volatile and bond yields have moved higher, and company leadership just seems to be changing direction and moving to a bit of a safekeeping ground. Despite this, it's obviously important to remember that markets trade on expectations. And so when the dust starts to settle and we start to understand the changes that happen in market positions, we do see rebounds and markets do stabilize. But nonetheless, I totally appreciate that if anyone's feeling uncertain about what's happening in the world right now, it's totally normal. So let's just take a bit of a deeper dive into what's happening. I'll throw over to Will, and you can give us an update on to what's happening in global markets in more depth.
Thanks, Joel. So globally, equity markets really delivered mixed results during the quarter. One of the most notable developments was a rotation away from large US growth and technology stocks, particularly those most exposed to the AI disruption risk. Investors became more selective, really favoring value-orientated sectors, energy, and smaller companies. While March weakness grabbed headlines, corporate earning expectations remained broadly intact. The recent pullback, though, has driven more uncertainty and repricing of risk rather than a collapse in an economic fundamentals. Struggle to get that out. Over to the US. The US remains the most important driver of global markets still, but the outlook has become much more complex. Inflation remains above the Federal Reserve's target, and the sharp rise in energy prices that we've recently seen really has increased the risk that inflation stays much higher for much longer. Now, as a result, expectations for rate cuts over in the US this year have faded, with some markets even beginning to price in the possibility of further tightening. At the same time, US market leadership has narrowed less than in prior years. While AI investment remains significant, concerns around valuations, earnings sustainability, and capital expenditure are really growing louder. The US economy is still resilient, though, however. Markets are now more sensitive to policy mistakes, inflation surprises, and earnings disappointment. Now, over to Amber, we'll cover off Europe and UK.
Thanks so much, Will. Yeah, so I'm going to cover off on the UK, Europe, and Asia, perhaps sectors that have fallen by the wayside in terms of what we've been focusing on, but great to touch on and understand exactly where they're positioned in the market today. So Europe showed modest improvement earlier in the year, but this was supported by, the rising real wages and the fiscal spending in those key economies. But the higher energy prices pose a real challenge, particularly for the energy importing countries. There's still fiscal constraints and political complexity. Also, that continues to limit Europe's ability to respond quickly to the shocks that we're experiencing. But all in all, the UK remains, fairly stable but still sluggish, and we expect growth to stay modest throughout 2026. If we then look to Asia, Asia continues to offer some opportunity, but the conditions vary region to region. So if we were to look to, export growth has slowed. There has been some strong activity, particularly last year, and the US trade policy, like you can see across many parts of the world, remains a key risk to many countries. But that being said, Asia is deeply embedded in that global AI supply chain, and they have really bedded down and supported the demand for semiconductors, data centers, and advanced manufacturing in that space. So still a lot of opportunity. China in particular is taking a longer term approach. They have been seen to prioritize consumption, high value manufacturing, and economic resilience is definitely being prioritized over that short term stimulus. We've seen trade flows that are increasingly shifting towards those emerging markets where opportunity can sit, helping reduce geopolitical risk and support that currency stability. Now over to Ben to talk to the Australian market.
Thanks, Amber. So I'm going to talk about the Australian market and then do a little bit about the Australian property and the outlook ahead to the rest of this calendar year. If we look at the Australian economy, it's still been quite resilient, but that really only tells us a part of the story. Inflation has continued to edge higher, which has been driven by energy and other price changes, while the labour market has continued to soften. The Reserve Bank obviously raised interest rates again in March, which shows that they are looking to be a little bit more restrictive than other markets such as the US, and that looks like it's going to continue to go on for the longer term. Equity markets, on the other hand, though, have continued to push to new highs over the last few months, and obviously we've seen a little drawback over the last month, which is to be expected. But earnings growth remains really weak, particularly across the banks and the miners, which just reinforces the importance of our view of stock and sector selection rather than relying solely on broad index-based exposure into the rest of the year. Turning to property. The first quarter delivered continued price growth nationally, but again, it's sort of a tale of multiple stories. If we look at Perth, it was the shining light. Overall dwelling values rose at just over 2% for the quarter, but the headline number masks very different conditions. Perth, as I said, was the standout, with prices rising more than 7% for the first quarter of this year, driven by strong population growth and a shortage of available housing. The demand continues to significantly outweigh supply, and the competition for quality stock remains really intense. If we look then at the two major capitals, Sydney and Melbourne, they're both softened. Sydney affordability is really acting as a ceiling, limiting the pool of buyers that are able to transact at the current price levels. Melbourne, meanwhile, is experiencing a more balanced market, high supply, and interest rate sensitivity really weighing on prices there. If we look at the other capitals, so Brisbane and Adelaide, they continue to record moderate growth supported by population inflows, tight rental markets, and limited new supply, while regional markets have also seen ongoing gains, although momentum is beginning to slow across those sectors. If we look ahead to the rest of the year, most economists expect that price growth will continue, but will start to moderate through the rest of this year. Interest rate uncertainty, higher energy and fuel costs, and that broader geopolitical risk that we've spoken about earlier are all impacting buyer confidence. Auction clearance rates, particularly in Sydney, suggest that the momentum is easing and conditions are coming slightly more balanced. We don't see this a broad-based downturn in our base case. Structural undersupply, strong population growth, and tight rental conditions continue to provide a floor under the prices. We expect greater divergence to persist, with markets like Perth remaining supported, while other more expensive cities, we see them being flatter or maybe even uneven outcomes over the next sort of 12 months. Back to you, Joel, for our outlook on 2026 overall.
Thank you, all of you. So I suppose it's probably just worth recapping on everything that we've just sort of discussed here. So, the theme of our investment thesis has really remained largely unchanged, and we are having that outlook maintaining with sort of cautious optimism. Whilst capitalism remains in its finest, volatility does bring obviously some risk into the position, but at the same time, there is a lot of opportunities as well that can be grappled with. So we're seeing stabilization in global growth that happens outside of the US, ongoing AI and tech-related investments, and supportive fiscal policies throughout parts of Europe, Asia, is continuing as well. So whilst risk remains elevated, given the geopolitical uncertainty and inflationary sensitivity that we're seeing in the market right now, it's definitely time to review what the long-term positions that you do hold and seeing what opportunities exist going forward. So I suppose going forward, what we see and continue to favour is obviously global diversification, quality companies, strong balance sheets, selective emerging markets pace, and a disciplined sort of long-term approach. Withoutstanding this, of course, volatility brings across some uncertainty there, and we've definitely been reminded this quarter how quickly that can come into our position, and it's sort of investors that have been sitting on the sidelines waiting for opportunity to take action here. Now it's potentially a time to really look at assessing what your position looks like going forward. It's definitely a time to book a review with your financial advisor to see how you're positioned, what your sort of longer term goals and objectives are, and make sure that you're going forward in a path that is confident, you're making the right decisions that are right for you. So all in all, I suppose the main message, it's time to book in a review. Thanks so much for watching, and we look forward to speaking with you soon.